I think we are coming up on the last shoe to drop before a recession. We've talked about the inverted yield curves. We've talked about inflation. We've obviously talked about the rising interest rates that usually rise until something breaks. We saw the bank runs. We saw the liquidity issues. And now we are finally seeing one of the most dangerous precursors to a recession, what we call a credit crunch. So here are the topics that we're going to be discussing in the video. Recession is all but certain. The last shoe to drop in the recessionary picture, a credit crunch. And don't worry, we will explain what a credit crunch is so that you know what to look out for. Smart money versus dumb money. What are the market players doing? We've talked about the VIX complacency, the VIX here being at January 2022 lows. That was the last market top. The VIX picture looks eerily similar to that, and we are now seeing the VIX calls soaring. Just today, as of the time of this recording, we saw 94,000 of the VIX 26 calls expiring in June coming in. That's $16 million in premium, and these were bought above the ask price, meaning these were aggressive buyers. In 2 videos ago, I covered in detail wage growth leading to sticky services inflation. So in this case, we're also going to be talking about market positioning and how to position yourself, or how we are positioning ourselves for this upcoming recession. Now, in the wake of the bank runs, we've been hearing this term credit crunch. We've even heard Jerome Powell mention it a few times. What is a credit crunch, and why is it so damn vital to the economy and to what is going on with the potential recession? Well, a credit crunch is exactly what it sounds like. It is basically a halt or a slowdown in lending from financial institutions. Now, it's not surprising that this is coincided with the financial stress index, something that is tracked by the Fed, but this is the highest time that we've seen since the pandemic and then since all the way back to 2009. As a matter of fact, I think this is the 4th highest time that we've seen on the financial stress index. This is because in the wake of the SVB insolvency crisis and the fears that bank runs would follow, banks have basically tightened up their balance sheets and tightened up lending because they don't want to hold too many loans, especially ones that are now at these new inflated rates. Because the higher the rates are, the more likely that you will see defaults from your customers, both businesses and consumers alike. So the consequences of a credit crunch are basically a slowed down economy as higher rates continue to wave upon us. If there is a slowdown in lending, that means there will be a slowdown in buying, as well as a slowdown in the growth of business. Also, one other thing is it messes up completely what's going on in the bond market. So right now, fund managers are the most bearish that they've been since 2009 with a net 10% overweight rating in bonds. And if we take a look at bond yields are more messed up than they were, and they were already really just in a web of entanglement with almost every single yield curve being inverted. But now we have the 1 month paying 3.9%, while the 3 month is paying 5.3%. This is a wide disparity even among the short-term treasuries. So when you see these treasury yields that are lower than the others, that means that investors and managers are pouring into those treasuries and ignoring the ones that are the higher yield ones. That's why you see most of the long-term yields, the 3-year, 5-year, 7-year, 10-year, 20-year, 30-year, they're all in the 3s because there is a lot of fear about the long-term or about the short-term future of the economy, and investors want to capture a longer-term yield. Let's get back to the credit crunch, though. As I said, this is the last shoe to drop in the recessionary picture. So here's how a credit crunch affects the economy, right? You have the Fed. So what does the Fed do? The Fed says, hey, we're going to be raising interest rates. So they raise interest rates. That means that banks then raise their interest rates as well. And they are also going to raise their interest rates because the Fed is raising it on them. But the Fed keeps raising rates, the fastest aggressive rate hike since the early 1980s. And all of a sudden, the treasuries that these banks have held are now underwater because as the Fed raises rates, the value of treasuries go down. So now these banks are exploding, and they would have exploded even more if the Fed didn't step in and backstop them. So let's just say that this bank explodes. Now we have this other bank here, right, that hasn't exploded, but it has witnessed the explosion of this bank. So this bank here says, hey, let me reshuffle the assets on my balance sheet, and also let me stop lending out to consumers and businesses alike, because I'm afraid that these people are going to default due to the higher rates. So, what does that do to the overall economy when nobody can borrow? Well, if you cannot borrow, then nobody can spend. And so the overall economy drops. Now, you factor in, obviously, that we have high, sticky inflation, especially in the services sector, which is why the core CPI actually came in higher year over year. You factor that in with the almost every single yield curve being inverted. You factor that in with we will have rising unemployment for sure, especially as wage inflation continues to wreak havoc on core CPI. And the Fed is going to keep these rates, even if they pause. I think they'll do another 25 and then pause. They're going to keep these rates higher for longer. So we will likely see something else crack. Now, economists fear that something else is boiling up in commercial real estate. Why? Because a wave of investments in this sector have to be refinanced over the next 2 years. And because of that credit crunch, they are literally going to be starved of the credit that they need to function. So if the commercial real estate markets need to refinance, and not only are they not going to find the credit that they need, but the credit that they do find are going to be at much higher rates, that obviously poses a huge risk, especially since there has been a bubble brewing in commercial real estate for a very long time. Now, let's talk about the smart money versus dumb money component here of the stock market. Now, I want you to take a look at this chart here of smart money versus dumb money. This is by a research group called Sentiment Trader, but you could see that the stock market tops right as the smart money starts to leave in a vicious fashion, and as the dumb money has overextended themselves. Now, they use a wide range of indicators to identify smart money versus dumb money. I'm not going to get into it here, but we are seeing this dynamic once again where the dumb money has followed this rally and the smart money has recently exited. And you remember that saying, sell in May, go away. Well, most of the time that actually works. I don't think it worked in the last few years consistently, but most of the time that actually works. Not a reason to sell in May. However, some of these factors here, for some of you, at least for me, is a reason to start deleveraging. And I'm going to pause real quick here and say that if you want to learn how to position yourself for the upcoming recession, if we're not already in one, if you want to learn how to not care what the market is doing, whether it's up or down, whether it's neutral or sideways, if you want to sharpen your skills and have this toolbox that allows you to be a smarter trader, come be a part of a large and vibrant community with thousands of traders that rely on each other every single day. There are traders in there of every experience level, but the beauty is you can ask any question you like at any point in time, and you will get an answer from someone who is most likely more experienced than yourself. We trade options, stocks, futures, etc. So click the link below and book a call with one of our ambassadors. If you are approved, you will know right away, and I'll see you on the inside. All right, so VIX complacency and VIX call soaring. We already talked about briefly in the intro the VIX call soaring, but here you could see the VIX complacency. We hit a low that we saw in January 2022, the last market top. Also, it's important to know that with these lows, this is why, to me, this is very similar to January 2022, because the VIX is actually in contango like it was back in January 2022. Contango is the normal profile of futures contracts where you expect future prices to be higher than current prices. Backwardation is when you have a declining curve where future VIX values are expected to be lower than where they are currently. However, we are now back to contango, which means we're expecting volatility to go up. Now, as I said before, when we finally have a recession, it's usually in the form of some sort of credit event that we can't see, right? A lot of people point to things such as, maybe the residential housing market, or in this case, pointing to the bank runs as, oh, that is it. That is the thing that's the black swan event. But the black swan event is usually an unforeseen credit risk. And with this credit crunch, as well as the high interest rates, I think we will finally get something. I don't know what that something is, But that is why I think we are seeing now a lot of VIX calls come in, and we are seeing that VIX curve back to contango. And me personally, I started hedging my portfolio with long dated VIX calls. Again, if you want the details of that trade and how I'm hedging, click that link in the description. Come be a part of the community. And lastly, now in terms of market positioning, let's take a look at the market and see what does the picture look like from a technical perspective. You know that we are currently in a very large earnings season, just the start of it actually, and we saw decent earnings by the banks, even though even if the banks actually had decent earnings, we know that the banks are going to be very stingy with that credit. Secondly, we had a miss on Netflix. We also had somewhat of a disappointing earnings report for Tesla. Now, that is not off to a good start. However, for me, I still think that there is, as I said before, I don't know that there's an impetus for the S&P 500 to get significantly past that 4,300 level. I really just don't see it. I think services inflation is going to be stickier than people think, even though goods inflation is coming down. I'm wary of the bond yield picture. The bond yield is signaling all kinds of things right now. It's signaling that the Fed shouldn't actually be raising interest rates further, but it's also signaling that they are not expecting a cut anymore. Also, we have to stop talking about the market in terms of bullish and bearish fashions all the time. Like what we're experiencing now could easily take us through a very long period of chop, which if you look at it really since May 2022, we've been in this long period of chop, but it could go on for much longer depending on the data points, right? We consistently get conflicting data points where one data point seems bullish, one seems bearish, etc. But to me, the overall picture is still uncertain. And I will continue to trade in and out each and every day, regardless of the market direction. For instance, yesterday I sold an iron condor for Netflix earnings. But today I also day traded Tesla calls before earnings, riding that run up and closing these before market close. So I'm definitely going to continue to day trade because this type of volatility is actually bringing a lot of clean price action and opportunities. And as I said, I'm going to hedge myself with the VIX. I'm also going to be selectively buying stocks. As I said in the Traveling Trader Academy a few weeks ago, that I thought XLF, the financial sector of the S&P 500, was actually a good pickup for the long term because of the overreaction after the bank runs, the fact that the Fed said that they're going to backstop all of the banks, were not going to lose even a single deposit. And we were basically back at levels that we saw right after the pandemic in February 2021. So for me, this was a good long-term pickup, as well as some of the oil names. And we are on the cusp of playing futures on the treasury yields. Anyway, traders, that is it for this video. Let me know in the description below whether you think a credit crunch is a big deal. What do you see from the commercial real estate sector? How are you positioning yourself in this market environment? Are you just moving along as is, or are you de-risking and de-leveraging a bit as I did back in the beginning of February? As you know, I'm always transparent with you guys as to what I'm doing. I don't aim to be right every time. Well, I hope to be right every time, but I'm not going to dig my heels in if I'm wrong. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.